Afternoon everybody, thank you for joining us. My name's Michael Fajardo and I'm on the relationship team here at Seven Investment Management. I'm delighted to be joined by co-founder Justin Urquhart Stewart and our Chief Investment Officer Chris Darbyshire to talk through sheltering portfolios around the Brexit decision.
Michael, thank you very much indeed. Forgive me, it may just appear that actually... Oh, sorry.
Sorry to interrupt, Justin. Before we get started, we will be taking questions at the end. And whilst you're listening to the portfolio, you can ask questions. I'm just going to show you how you can do that now. So if you look on the right-hand side of your screen, you'll have a grey box. If you select where the arrow is pointing to the plus sign, that'll open up the question box. And it's purely a case of typing in the question where it says enter a question for staff. And then finally hit the send button. And hopefully we'll be able to answer as many questions as we can. Over to you, Justin.
Michael, thank you. I'm sorry to talk over you there. That's a very useful description. I haven't seen that one before. May I just say, first of all, thank you for coming in this afternoon. Also, if there's some strange, obtuse and rather strange drilling noises halfway through, I apologise in advance. It's happening somewhere in this building. It's almost like working in the BBC. So, welcome. We're talking about sheltering portfolios around the Brexit decision. Obviously, this is crucial for us all. And of course, as days go by with the polls bearing the whole time, it's going to be fascinating to see. So really we're going to talk through with Chris this afternoon what action he has taken or how his brain is working to take account of what's happened so far and come to that, what might happen in the next few days. Chris, not easy for you.
No, it's certainly not. Well, let's take a look at whether the referendum is having an impact on investments generally. So I've got a chart here of the UK stock market. This is the FTSE 100. And the chart starts on the date that the referendum date was announced. So it was announced middle of February, chart starts then. This is the FTSE 100 since then, and you can see actually, strangely you might expect, it's actually up over this period. However, it does take a bit of a turn down at the end of the chart there on the right. Why is it up over the period when we've got a risk ahead of us? Well, you know, it's possible that concerns not related to Brexit are having a bigger influence on the stock market than those that are. For example, company share prices are often driven, you know, by expectations for company profits. And of course, we've had a big rebound in profit expectations for the oil companies, so Shell and BP are in there, and also the commodity companies that are also listed on the London Stock Exchange are in the FTSE 100. Also, individual stock markets move more and more now according to how global stock markets move, and there's less and less country-specific events seem to be included in the pricing. Now, let's also remember that the FTSE 100 not really UK companies anymore. So only about 25% of the revenues of those companies come from the UK. Many, in fact, just have head offices in London or just happen to have their shares listed on the London Stock Exchange, but most of their business is conducted outside the UK.
Of course, this is particularly infuriating for many of us when you're sitting there watching the sort of the 9 o'clock news from Hugh Edwards or something like that, and he's referring to the FTSE 100 having gone down 160 points. Therefore, it's obviously the UK economy. Therefore, it's obviously connected to me. When obviously it's not.
Hasn't been for a long time.
But the impression and therefore the confidence that goes with it is obviously affected.
Yes. I think you've got to be very careful how the events are related and how, you know, made into chains of cause and effect in the media, particularly going into this period, because there is going to be a desire to sensationalise and exaggerate the newsworthiness of events over the next week.
Hyperbole has been astonishing, hasn't it? I mean, and we've also had particular issues we should mention about sterling and also, I suppose, some of the government debt and gilts as well.
Yes, we'll come on to those.
My apologies, sir. Carry on.
So what's important for investment portfolios about this chart is that you could argue investors looking at this are not that concerned about the economic consequences of the vote. In which case, stock markets won't really move very much, and there's nothing that an investor needs to do. Alternatively, you could say that maybe investors do not think this is likely to happen, even though the consequences could be quite bad, and that throws up a different problem, because then stock markets, you know, shouldn't move if investors are right on the whole, but something needs to be done in case they are wrong. And then I think there's a third possibility here, which is that investors are just making a mistake. They're too complacent both about the economic consequences of a Brexit and the probability of a Brexit. And in that case, you've got a real potential big shock to portfolios out there, and you need to protect against that.
Okay, and that's some of the issues you're going to be going through the time.
Absolutely. The big shock, interestingly, it isn't the UK economy, and until Brexit came along, investors really weren't that concerned about the UK, but they were very sensitive to the eurozone, and in particular to the risks that the eurozone might break up. And this is the problem with Brexit. It could reignite fears of eurozone disintegration. So what you might get is, okay, UK votes to leave the EU. There's a big impact then on European stock markets because investors believe other nations are encouraged to leave, which means the eurozone breaks up, the EU itself might come apart or change radically. You've got to now a lot of uncertainty out there. When will this happen? You know, what will the odds be if you get a referendum, say in the Netherlands? What will the odds be of them voting to leave? You know, what will drive those votes?
This is a serious concern I was finding on the continent, that actually all you're doing is starting to unstick the sweater. How far along could that wall just actually unpeel the whole thing?
Exactly. So you're in a situation where actually the European stock market goes down a lot after a Brexit vote. And that means that the UK stock market then gets impacted very severely because people will put two and two together. The Eurozone's our biggest trading partner. If it's doing bad, doing badly and economically hitting distress, we will too.
So it's not a domestic issue so much being worried about the back wave, it's actually what others do to it.
Exactly. I mean, we live in an increasingly interlinked world. And we are in a situation where the biggest impact on a UK investment portfolio wouldn't actually be the UK leaving the EU, it would be what it means for the future of the EU and the Eurozone. So we do have something to protect against.
So certainly a very different argument from what we hear at the moment just domestically at the moment, which is all about really what's going to be happening just purely within the UK. I have to say one of the points I picked up last week, it was in Berlin, were the primary issues to why you shouldn't have a referendum in the first place was coming from actually the French and Germans. Well, we haven't had a war for 60 years. Which is important over there, but doesn't play very importantly over here. Very different sort of attitude.
Yes, I think we've, the Conservative Party really had a political problem that it wanted to fix, to address, and the referendum is the way. So it's really, I think, more about party politics than any kind of inherent desire among the UK population to discuss this issue and put it onto the agenda like this.
Their own problems. Oh well. Anyway, well, back to the issues of the market.
Yes, so I do think there is a very nasty potential market shock. However, just having painted this picture, I also want to give my views of how things then play out, because I think it is primarily a market shock, not an economic shock. So, and I've tried to make that clear on this page by showing, the Wall Street Journal, the 1920, the Daily Mail from 1929. And you'll note that it was a continental edition.
Where have they ever produced that?
All the adverts.
A nice reasonable hairline, greatest crash in Wall Street's history. It's something they use quite regularly, actually.
So why is it? So for a start, if we vote to leave, we have a long renegotiation period. Now under the treaty, that's a 2-year period, but it can be extended. My guess is it's extended because it's a very, very complicated renegotiation. So you're probably looking at 5 years to assess that, and then you actually have the UK then having to, of course, enter new trade treaties as well around the world, not just with Europe, and that. So I think you're looking at sort of a 10-year process for the beginning to end. So unlikely to see much in the short term. Now, when all that is said and done, will it actually involve much economic change to the UK? Well, I think probably not. The EU is our biggest trading partner, and we are the EU's biggest trading partner. Believe it or not, the EU exports more to the UK than it does to the US, than to China, much more than to China. So it's natural that our interests should be closely aligned, and it's natural that our interests are closely aligned through trade treaties. So we're going to get back into trade treaties with these people that we're leaving. So I think nothing actually changes that much in the end. We have maybe a different kind of political set of rules governing those.
But we have seen a backdrop change, though, in terms of some of the confidence of this, because with confidence we've seen in terms of new investment coming into this country, it was very positive last year, now seems to have dropped off significantly.
Yeah, it's dried off a lot. It's mainly anecdotal because we don't see it so much in the data, which is rather backward-looking, but anecdotally we're hearing that investors who would normally be investing in, say, the UK property market or the UK mortgage market, and so on, or UK businesses, have just stopped dead. why would you invest now, not knowing what the rules of the game are going to be in a few weeks' time?
So we have to get that started again then once it's over, or rebuild that confidence?
Well, I think what we have to do is we would have to reassure those investors that we're not going to go through this again, that we are a safe haven, and I think that is also a process that's going to take some time. So I think there are definitely, even if we vote to remain, there are definitely still consequences here. But anyway, back in our Brexit scenario, there's also political and economic inertia. At least if you think about the 5-year time frame that I'm outlining here, at least one UK government will have come and gone in that time, and the new government, Labour or Conservative, might have a different view, and it might even have time to hold another referendum. And so so this is a process that is not going to happen. So I think, as I say, I think it's a market problem. I think it's less of an economic problem just because of the very slow time frame that things happen over. Okay. So how do we protect portfolios against this risk? I've highlighted the problem already that the stock market hasn't really moved down that much, and therefore it probably isn't going to move up that much if we vote to remain. It's just not got enough sort of momentum either way. But one asset class that has really been moving, has got a lot of volatility, is sterling. So this chart on this page is what we call an intraday chart. So it's sterling from the beginning to the end of a day, and in the middle of that chart I've highlighted where Boris Johnson announced he was for Brexit. And you can see it's a very big decline in sterling, one of the biggest ever actually in history. So we know sterling is sensitive to this problem. And there's a very good reason for that, and that is that the UK has a very large trade deficit. Simply put, we import much more than we export. Our trade deficit is one of the biggest in the world, and currently it's actually the worst it's been since records began in 1948. Now, this has implications for sterling, for pound sterling. There's a lot of downward pressure on sterling coming from the fact that we buy stuff abroad. And this is normally replaced by foreigners buying things in the UK, as he said, just in, investing in the UK, investing in land and property in the UK, or just buying our exports,
or buying our debt,
or buying government debt, helps to offset that. And I think there's a very real fear that the uncertainty surrounding Brexit reduces these offsetting flows, and pound sterling therefore really does begin to decline quite significantly.
Pushing that a bit further, could that mean that we have to pay more for our higher yield on our debt just to try and get people to buy it?
Yes, you would. Well, immediate impact is cost of buying things abroad will go up, and that would then feed through into inflation. And of course, a lot of our debt is inflation linked in the UK, so yes, there is a knock-on effect in government debt. Now, this can be exploited, though, to stabilise portfolios. So it's both a risk and an opportunity for investors. So when the pound falls, investments denominated in foreign currencies will rise in value. And of course, they'll have their own ups and downs going on at the same time, as they normally do day to day. But on top of that, you've got, if the pound is down 1%, you've got a 1% increase in the value of anything in the foreign currency. It's a bit like booking your holiday abroad being more expensive after a fall in the pound, and vice versa. So this is a useful portfolio management tool. In our portfolios, we have a lot of investments from around the world. Don't just hold UK investments. So we've got many investments in US dollars, not just American investments, but actually other investments around the world quite often get denominated in US dollars. It's the convenient currency of choice. We've got investments in euros. So while the euro might fall in the kind of Brexit scenario I'm depicting, I think the pound still falls by more, so you still get a gain there from holding euros. And we have emerging market currencies in the portfolios, which have been relatively steady against the pound, and also we've got a small allocation to gold as well at the moment, which is apt to rise quite fast in a situation where people are worried about risks and worried about currency volatility.
You actually bought that quite recently, didn't you?
Yeah, a few months ago we bought that, and it's beginning to kick in a bit now.
Yeah. So all of this just shows, therefore, that the biggest swing factor in portfolios is going to be the currency.
Exactly right. I think focus on the currency rather than the stock markets, and the way we've done this is on this slide here. So if you look at the kind of bottom horizontal bar, that's all the different assets we own in our portfolios. You can see a wide range of them. Many of them are international assets, they're not UK assets.
So this is the balanced portfolio generally.
This is our balanced fund. What we've got, among those assets, we can take any foreign currency exposure we deem appropriate. So we have the tools available to us to hedge currency exposure, which means to either take or not take the currency exposure that comes with an investment. So if you think about owning the US stock market, you've got the exposure to the stock market ups and downs, but you've also got exposure to sterling dollar. And so it's the sterling dollar risk that we can isolate, and then we can then choose to take all of it, none of it, some of it, as we deem appropriate. And the horizontal bar attempts to show this in a kind of a Brexit situation. So what you've got is, you've got on the left-hand side of the chart, you've got a situation where we vote to remain. And if we vote to remain, we think sterling would be very sensitive to that and will run up very rapidly indeed to about $1.50. On the far right-hand side of the chart, we've got a vote to leave, and this is the situation in which we think sterling depreciates very rapidly, down to perhaps even $1.25.
So within that, where are we currently sitting?
Well, so what we've got is two lines on this chart. We've got the dotted line, and we've got the straight line. So the dotted line is telling you where we would normally be. So this is how our portfolios are normally positioned, you know, without any referendum going on. And you can see that it's about 45% foreign currency, about 55% sterling.
So quite deliberately underweighting that exposure to sterling.
And so, yeah, so if we move to the right to our tactical, which is where we currently are positioned, we have deliberately, as you say, taken less sterling exposure and taking more foreign currency. So we're running at about 60% foreign currency exposure and about just under 40% sterling exposure. And the basis for this is that as we head towards the referendum, we think sterling falls, and assets generally will fall because people will worry about the outcome of the referendum, but of course our investors gain from the foreign currency exposure. So the two should offset.
And the bit I think is vital here is that actually you've been able to bring in some of the institutional structures of proper currency hedging, which many investors won't get in the retail market, and so they're just left exposed to this. They have the investment, but they could still be, whatever the pound or the dollar does, they're at risk.
So we can do this because we run funds, and funds you have the ability to do more, they're more flexible, and they're bigger, you've got economies of scale. So, you know, investors, it's difficult for individual investors to hedge currencies cost effectively.
And then within the asset allocation exposure, has there been any major change to the asset allocation across that rainbow of colours at the bottom?
Nothing major. I think we are tinkering, certainly, but I think we regard the currency as being the most predictable and stable way of getting protection we want in the portfolios. And you know, part of the reason for that is when I showed the chart at the beginning, the stock market chart, it hasn't moved that much.
Right. So let us carry on for the medium term, but try and hedge the risk.
Yeah.
Okay.
And so we'll keep looking at this currency position, and we'll keep adjusting our views on where sterling goes to in a leave or remain situation, and we'll keep balancing our currency positioning to try and balance out the risks to portfolios of a remain versus a Brexit.
Okay. So I suppose the issue is, right, what happens next? Here we are.
Of course, once the referendum's over, there'll be another portfolio risk on the horizon.
Yes, how to deal with this? The startled bird on the right there was actually supposed to be a picture of Boris Johnson, but I decided we tried to be slightly less cruel about it. This is on the basis that the only winner, of course, was going to be L'Oreal, who produce Elnet hairspray. So that's going to be another issue for us to try and manage thereafter. Now, we're very happy to answer any questions, so please, I think as Michael talked you through at the beginning, if you have any questions, please do put them through and we'll ask them as soon as we can. And also, just to say, whilst we're talking through this, our next webinar is actually going to be on the 20th of July on 10 a.m. and actually 1 p.m. as well on that day. And so if anyone's got any questions prior to that, then also please do let us know. I'm also very keen to find out if this sort of way of briefing you is how you'd like to have the information fed through to you. Chris has produced another paper actually on Brexit only I think a few days ago. If you'd like to have copies of that, happy to send that through. We could keep as much information as we possibly can. In terms of questions coming through, Michael, what does that one say?
It says, do you think your strategy is being matched by other funds?
That's an interesting point. Chris, what do you think? Have you seen them much?
I honestly don't know. I think funds that can hedge foreign currency exposure will be using it as a tool. But they may be using other tools as well.
Yeah, I mean, the comments I've had back from houses have been they've been de-risking portfolios, and I've been saying, yes, and that means what?
Well, the problem with that is that if we vote to remain, you're going to then have a sudden uplift in the value of the equity, stock markets and so on, and the currency. So that's why we've tried to focus on the lever that we can pull, and the lever that we think will work.
Yeah, and there's a lot of houses saying they've increased their cash positions very significantly, but as you say, it's all very well being cash, trying to get back in then at the right time.
Yeah, so unfortunately markets will move so fast on the morning of the 24th that you probably won't get back in.
Okay. Just another question coming through here. The cash that is being held in the portfolios, is that held in sterling or in a mix of currencies? How do we do that?
Yeah, so we hold our cash in sterling. We have ample foreign currency exposure through our other portfolio holdings, through the investments that we make abroad, that we don't need to do anything with our cash position.
Okay. We'll go to Michael. We had another one I saw there appear on screen.
We have indeed. What will markets do in the event the prospect of a Trump-Johnson axis emerges?
And who's that from?
That's from Mike James.
Mike, okay, Mike, thank you for that. Well, that's a bit further ahead, to say the least, but nonetheless, it's in our brains to actually at least consider.
I think so. Yeah, it's an interesting situation. It will be what does that reflect if we've got Trump and Johnson in power? Well, certainly we voted to leave, I think, at that point, and then try and take Trump risk into account. I don't think actually Trump can do that much damage economically. I think his risk is more on the sort of geopolitics side. So the US president doesn't have a lot of power actually to make changes to the economy, because he has to go through the Senate and Congress, who can vote him down. There's three parts to the US government. There's the president, and there's Congress, and there's Senate. So it's not like us where we just have the two parts.
The good news is we've got everyone's favourite auntie, Janet Yellen, actually running the Fed, and she's the one that makes the primary decisions on that.
Seems to be moving the economy more than anybody else. So I'm relatively relaxed about a Trump risk for the economy, but I'm a bit concerned about geopolitical risk and how we would play with the Chinese, for example, in the South China Sea.
And that's an area close to my heart. And certainly if Boris comes to power, remains to be seen if there's what sort of Tory party you end up with on the basis of that. Michael, I think there was another one, slightly longer question there.
We've had a couple of questions come in. Firstly from Ian. Thank you, Ian. Given the fact that the Fed is concerned about the effects on the real economy and has delayed a rate increase decision, why do you feel that the effects on the real economy will be minimal as a result of Brexit?
So the Fed hasn't yet delayed its. I think the reason the Fed has delayed its rate decision is much less to do with Brexit than it is to do with the US economy itself. I think Brexit plays a part in the Fed's thinking, as does China, as do international events generally. But I don't think it's the problem. The problem for the Fed is that they had a weak payroll data number a couple of weeks ago. Why will I think it not? Well, my point is, and I'll just reiterate what I said earlier, that nothing is going to happen overnight. This is a long-term renegotiation of a treaty which binds us very, very intimately to Europe.
The country still operates, but it's that question of confidence, is it?
It's more the confidence impact, and there will be some confidence impact, but there'll also be a realization after the vote that nothing will happen quickly.
Okay.
You may have, I'm not saying it's, these things are possible, but I think we have to go with what's the most likely.
We've got time for one more question, I think, and this comes through. Do you expect to be making fine adjustments right up to the referendum? And that's from Andrew. Andrew, think of that?
Yeah, I think we'll, if the situation is very volatile going right up to the referendum, if we're getting big swings in sterling and big swings in asset classes, then we may well have to make some adjustments. However, at the moment, we've not made really any significant adjustment really over the last couple of months. So what's happening is our sterling position is doing a very good job of counterbalancing what's happening in markets. So markets up, sterling sterling down. Sorry, markets up, sterling, markets down, sterling down, and that's been a great way of stabilising the portfolio. So you'll see over the past couple of days they haven't really moved very much, and that may actually carry on and may be actually a very useful tool. So we may not have to do too much.
Okay. But I think there's a key issue to remember here is that investing is a medium-term issue. It's not a short-term issue. The hyperbole of the headline, sadly, means that everybody's being driven to these short-term concerns. We have to just try and manage through this.
Yeah, and the one thing that people should not do is panic. And the one thing that the media will sort of be, the message they'll be sending is that there's panic. We should panic. You know, so I think absolutely don't panic. You know, and you know, economies tend to right themselves. When something hits them, yes, it's a short-term problem. It'll certainly be a short-term problem in markets, which is, you know, our problem as investment managers. But economies are very good at rebalancing, and they do that through currencies.
Good. Okay, and that's the one we're watching. I think the other thing we should all remember, if we're investing, we're still investing in terms of longer-term returns, getting our compounding of dividends over time, and frankly, we mustn't interrupt that. Let that carry on growing. It's a medium-term game, not a short-term punt. That's why we have racehorses, I think. Nothing to do with this. Ladies and gentlemen, thank you very much indeed for your time. I hope you found that useful. Please do let us know whether you think this is worthwhile. Happy to try and repeat it. Our next webinar is on Wednesday the 20th. At 10 a.m. and at 1 o'clock. And in the meantime, please pass any comments back to Michael. His email address is there. And thank you for sparing the time. And thank you very much indeed, you two. Thank you, Chris. Thank you, Michael.
Thank you.